Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's webinar, using implied volatility in changing markets, we'll take a look at how IV can affect your position when the underlying stock soars, falls, or goes sideways. As always, we'll cover the material as well as your questions in a quick 60-minute session. Our instructor today is the OIC's Director of Retail Education, Mr. Joe Burgoyne. Joe has spent more than 3 decades in the financial industry and brings a special understanding of options and investments to our discussion. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you're able to submit questions at any point during the presentation. Joe will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. For your convenience, you can access a PDF version of today's content via a download link that's just below your slide window. And if you'd like to review the entire webinar, an on-demand version will be available a few hours from now via the same link you used to join us today. Additionally, our previous webinars can be viewed on the OIC YouTube channel. And now, ladies and gentlemen, Joe Burgoyne will bring you our topic today, using implied volatility in changing markets. Joe?
Nick, thanks so much, and as always, thanks to everybody for joining us. I just want to double back with one of the things that Nick said about the surveys. That's actually how we came up with today's topic. We do look at all those surveys. I think there are about 7 questions we asked you. We look at them closely, and there were a lot of suggestions in terms of topics for future webinar that asked for more information on implied volatility. So we took those suggestions. We've rolled it into today's webinar. We hope you enjoy it. And then I added the changing markets portion. If you go back to the 4th quarter of last year, really last October, that's when the market started to have some increased volatility, and that seems to, it's not quite as extreme as it was last October, the current market vol, but we do have a fair amount of it. So anyway, Nick, thanks for the introduction, and those of you on board here, if you wouldn't mind continuing to fill out those surveys, we do use them, so thanks. So getting started, we do, as an industry, we offer our characteristics and risks of standardized options. That's a booklet that if you have an options account, you should already be familiar with. You can get that either from the OCC or your broker. Those of you who are new to us here on the webinar program, it's important you understand exactly who the OIC is. We are the educational arm of the listed options industry, and we are funded by members of the OCC, which is the Central Clearing Corporation, along with the option exchanges listed here. That's how we exist, and we have been funded by the industry since 1992. Those of you who have heard me before know that this is one of my favorite slides, just because it is really in one snapshot the picture of the growth of our industry. It's an industry that started in Chicago in 1973 with 16 underlyings, traded 900 contracts, 900 and some odd contracts that first day, and now we trade on average close to 17 million contracts a day on the 12 exchanges. And annualized, that takes us to about 4.3 billion contracts. So there's been tremendous growth in the industry. A lot of investors, just like you, have decided to, at a minimum, explore options, the listed options product, and many, in fact, are using the listed options product frequently to both generate income and manage risk. Today's presentation, we got a number of slides, cover a lot of things. I mean, volatility, I don't want us to get too complex. So we're going to go through, different factors here. We'll get into, a little bit of a conceptual review. We'll talk about, premium and pricing factors, things of that nature, and then we'll get into historic and implied volatilities, compare the two. We'll talk about where to find them. We'll go through some practical examples, why, implieds change. And I think importantly, we do want to talk about some strategies before we wrap things up. And as Nick said, we're certainly going to leave time for your questions, because always enjoy the give and take that we have, with the listener questions. So volatility as option risk. Volatility really is a measure of how much an underlying either has moved in the past or may move in the future. And when we talk about volatility and options, we get into these whole ideas of rights and obligations, depending on whether we're option buyers or sellers. We talk about exercise and assignment. At expiration, will an option be in the money? If it is, then of course it'll be exercised, and the seller, will have an obligation of assignment. And when we talk about volatility, we're really oftentimes backing into the expected price ranges of the underlying stock. I think that last bullet there talks about where is stock likely to be trading before expiration. Your expected volatility reflects this. And then, the beautiful thing about the markets is that, you never know really from day to day whether, there's going to be a dynamic, well, there's always a dynamic aspect to the market, but whether the characteristic of your particular underlying may, stay the same or change. So I said we go over a couple concepts, and again, because options at expiration, of course, are only to be exercised or only have value if they are in the money. So we get two components when we talk about options premium. We've got the intrinsic value, which is certainly at expiration the all-important in the money amount. And then the second component of any option price or premium is time value. And that's why, for those who have heard me before, whether through the webinars or, presenting around the country, I love to talk about volatility, because every option has, some amount of time value. I mean, unless we're the day before and you're deep in the money, I mean, almost every option has time value. And that time value expands and contracts essentially because of implied volatility. And so what's more important than the price of your options? I don't think anything. And the key driver is this whole idea of volatility. So, understanding the two components of an option price or premium: one, intrinsic value, if in fact there is any in the money amount, and then, the other portion is time value. Now, the factors that affect time value up until expiration, those option pricing factors are time itself, how much time to expiration, the cost of money. And when we talk about cost of money, we're talking about interest rates and dividends. And then, as I say, this whole idea of volatility. And the wild card out of those three is volatility. I mean, time to expiration, that's clearly definable. Cost of money, for the most part, we know, what rates are. You go out, maybe a couple of years in time, you get some variable there, but even with rates as low as they are, that is not too significant a factor. Volatility, though, is this component in pricing that oftentimes is unknown. So one thing that's important to understand is that volatility does not imply a trend. Volatility reflects fluctuation, but not a trend, and that's a big difference. So not necessarily moves to the upside, the downside. It just strictly refers to fluctuation. And then I like to refer to stocks, as their personality. Are they volatile or are they not volatile? Obviously, we got a couple here. The dark line would be the more volatile stock, obviously, where the I guess that's a reddish color, more of a flat line stock is clearly less volatile. So, when we talk about that, at least I think about two different types of volatility, and why don't we start by at least going through historic volatility. Historic volatility is factual. It's a statistic. There's no predictive nature. Just like the slide is suggesting, it is an observed and quantifiable amount of information that we can basically label a stock. So it has X historic volatility. If it's a high-flying stock, it's going to have a rather high volatility. If it's just a bit of a slow flatliner type stock, then it's going to obviously have a lower volatility. Historic volatility does get calculated a number of different ways, and so when you're looking into historic volatility, you just want to be clear. Typically, it's calculated on an annualized basis, but there are other ways to do it. Typically it's annualized on closing daily prices. I personally used to like and do like tracking volatility when you can include the high and low points over the course of the day. And you have to, of course, be clear on what time frame of historic volatility is being measured in the platform that you're using. But again, the historic volatility is all about how much the underlying has moved in the past. Doesn't mean it's going to stay the same way going forward, but it is a real crystal clear mathematical number as to how much it's moved in the past. Historic volatility, you can find the number all over the web. Your brokerage firm is certainly going to have that information. Various quote services at our website, optionseducation.org. You can find historical volatility on any of the 4,200 plus underlyings that we do trade options on in the listed universe. And again, that's optionseducation.org. Again, important that you're aware of, whether that historic vol is being calculated on a daily or weekly basis. If you're so prone to, doing these types of calculations yourself, you can do that as well. Your platform will point out all the Greeks, and as the slide suggests here, there's going to be an area on your platform that will point out Vega. Here is our snapshot. It's a combination of the implied versus historic volatility. The dark line is the 1-year movement of historic volatility in this particular underlying in the chart form. We've also got the box form up top where you can see it just numerically as well. So at optionseducation.org you can get that historic as well as implied volatility figures. But notice that there's a fair amount of variation in the amount of movement in, this particular underlying based on its historic volatility. So the effect on prices, and this is where, when we talk historic volatility, it's a little bit subtle, okay? Important to remember that volatility strictly represents price fluctuation, not up or down moves. So as the stock volatility increases, we're talking about the stock volatility, the historic volatility, generally put and call prices will increase, but they don't have to. I mean, it would make sense as you get a wider dispersion of prices in your underlying stock that the time premiums will increase in the options, but they don't have to. And as volatility decreases, as historic volatility decreases, generally the call and the put prices will decrease, but again, they don't have to. And that's because historic volatility is that measurement that talks about how much the underlying's moved in the past, and we'll get into the difference between it and implied volatility. Speak of the devil. So implied volatility, the big difference here is that implied is the market's expectation for future stock movement or future stock volatility. Only the options have implied volatility. So historic, it's how much the underlying's moved in the past. Implied is the whole market's, basically prediction for how much they expect that underlying to move going forward. Maybe as much as it has in the past, maybe less, and whatever the market expects, that amount of movement will be implied in the option volatility. So here's a snapshot with a couple different strike prices. We got the 180 and the 185s. You can see the platforms. Depending on your platform, the implieds will come up in different places on the platform. But as you move out of the money, the option implied volatility skews tend to get a little bit less. Getting back to that subtlety between prices, call and put prices going up or down as historic or implied volatility changes. As I mentioned, when historic volatility increases, when the amount of movement in the underlying does increase, generally option prices will go up, but they don't have to. Now when we talk about implied vols going up, when implieds go up, the calls and the puts absolutely go up in price. Okay, and that's that subtle difference I was referring to. Historic is kind of out there by itself, where the implieds, when the implieds start to go up, the calls and the puts are going up. The premiums are expanding when implieds go up. And the opposite is true when implieds decrease. Your call and put prices will go down. Same situation in terms of finding implieds. Optionseducation.org. There's no better source, for finding historic and implied volatilities, along with our thumbnail charts that are great snapshots that go back a year. You can certainly get that from your brokerage firm as well. And if you are so inclined to calculate yourself, have at it. In terms of what affects implieds, well, for those of you in the market space, you know that dynamic aspect of the market. So many things impact the market itself, specific indexes, and filtering down to stocks specifically as well. Hard to know exactly what drives premiums. I mean, when we talk about earnings expectations. Obviously, depending on the history of an underlying, if there are earnings announcement histories that really are kind of all over the place, clearly implieds are going to go up before those earnings announcements because of the uncertainty and lack of confidence that the street has on where the underlying may go after that announcement. So, an awful lot of this is common sense. Supply and demand, obviously, big call buyers can drive up premiums, and same with the put side, doesn't matter which side, but simple supply and demand is going to change those implieds. Fundamentals, sometimes, rumors, certainly, been in a lot of option pits where, forget about facts, rumors would drive those implieds to crazy levels, and that happens, frankly, all the time. Overall stock market psychology, this is where, depending on how close you are to your portfolio, if you are somebody who is really in tune with the market a lot throughout the course of the day, and I'm not sure how many of our listeners are fit that category, you can see that different announcements over the course of the day can move the markets. Maybe it doesn't filter down to the implied volatility of individual issues, but certainly it can be a driving factor for volatility in the markets. And generalities, and as the market rallies, typically there's less uncertainty. Less uncertainty means lower option premiums most of the time. When you talk about a drop in the market, clearly that uncertainty comes into play and premiums expand. That's just how the market works. But that last bullet on this slide here, points worth repeating. Multiple factors affect implied, and the collective effects are dynamic. And as I said at the outset, to me, that's what really makes trading the market so much fun, that dynamic aspect of the markets where you're never quite sure, what's driving the implieds, but, looking at the price levels of those implieds just like you would the price levels of a stock, to me is an awful lot of the fun in the option space. Are changing implieds a good or a bad thing? Well, again, back to common sense, it's going to depend whether you're long options or short options. Long options, obviously, you're going to want implieds to go up because the premiums are going to go up. And that's the case with calls and puts. If you're short options, clearly, you're looking for implieds to come down. Now, and we'll get into this a little bit later on, you can be long vol and short vol, with lots of different option positions coming together. It doesn't mean you have to be net short options to be net short volatility in a position. So, again, from a common sense point of view, higher vols, higher premiums. The higher the premiums, and the reason the premiums are higher because, no one maybe is quite sure, what the range of this underlying stock's going to be. So the greater the fluctuation, the higher the premiums that the sellers want for the added risk of this stock moving all over the board. And conversely, then the buyers, of course, have to turn around and pay more. And the opposite, of course, is true with lower premiums. Buyers are going to pay less because there's less fluctuation in the underlying, and so, of course, sellers take less. So just a quick comparison with a couple slides before we get into some of these using implied examples. Will an implied's level return to the historic volatility level? And we will have another couple charts that will show that that's not necessarily the case. That relationship between implied and historic, in my experience, most often the implieds trade at a slight premium to historic, but that relationship does change over time. And as we saw in a couple of the charts earlier, at optionseducation.org, you can get a snapshot of that relationship over the course of a year, a full year, 4 earning cycles, on our implied and historic volatility charts, which you can find under the tool and resource drop-down bar. Another question here. Why be concerned about implied? Well, I said earlier, we got two pricing factors when it comes to understanding premiums. We got intrinsic value, if there's any in the money amount to your call or your put, but then, most all options do have time premium, and that time premium is driven by a couple factors, but primarily implied volatility, and that's why we care about this so much. Sometimes the implieds will be a heck of a lot higher than the historics, whether that's rumors, just lots of demand for options. It's oftentimes hard to know why, but that does happen, and it doesn't necessarily mean that something's going to happen down the road, but clearly, there's added interest in that underlying. And the other thing about implied vols, they can change like snapping your finger for no apparent reason. They can change, obviously, intraday. They can change very abruptly. They do not necessarily require a stock price change. The historic volatility doesn't have to change. It's just this whole dynamic aspect of the options market. So there's that chart I was referring to earlier. The blue line is the historic volatility over the course of the past year, and that gold line is the implied. So you can see over the course of the year, almost always the implied traded at a premium to historic, but you had a fair amount of movement. I think we go from about 8% to maybe 14% in historic, and implied from around 15% to well over 20%. And that one spike right in the middle, whether that was, expected earnings, whether there was some story about rumors about the underlying, that would be, my guess. There were some rumors flying around about that company, and that's why implieds and time premiums, the premium in the options got so high. And my sense is that just looking at that chart, not even knowing what underlying it was, clearly the way the implieds came back to their midpoint level, whatever the market expected, it didn't get. And so, that very well, may have been earnings. And then we came back to a much more normal level of implied volatility. But as I said earlier, like your underlyings, knowing the price of your underlyings, try, if you are so inclined, to get a sense for the price level of your implieds, and those price levels are going to give you a sense of how much movement you can expect in the underlying going forward. So a couple pretty simple examples. Number one, we got XYZ Debt 50 call. We buy one of them for $3. Stock's $50, 60 days to expiration. 1 day goes by, so no real fade in the option. Stock stays at 50 on the close the following day, but the Debt 50s go to 3.25. What happened? Well, the price of implied volatility went up. In our example, we say it went up from 35 to 40%. The stock moved around a little bit, but it closed at the same price. But you got a decent appreciation of those calls strictly because implied volatility went up. So it's good if you bought that option, wouldn't be so good if you sold it. And as the calls go up, so the puts go up too. So just keep that in mind. If the call added, in this example, 25 cents worth of premium, the put is also going to add close to that 25 cents of premium to keep that relationship between the underlying, the put and the call in line, that whole idea of put-call parity. Example number two, we buy an XYZ June 60 call for $5. Stock's at $60. Again, 60 days to expiration. Next day, the stock goes to 61. Good thing. We're long calls. The call goes from 5 to 480. What happened? And I'm guessing those of you in the option space out there, you've seen this happen. It's happened to me thousands of times, without question, thousands of times. And that's implied volatility, coming in pretty significantly. In this example, 20% over the course of a day. Stock up $1, the $5 at the money call down 20 cents as implieds, go from 50 to 40. That's a big move. That's extreme. It does happen. I'm not suggesting that it doesn't happen, but it's why it's a good idea to have a sense for whether, the options are either long or short. Are they at relatively high or low levels of implied volatility based on their past? Example number 3, we're doing a covered call. So we're going to buy the underlying. We buy 100 shares of XYZ for 78, and we sell a SEP 80 call, $2 out of the money, at $4. Very next day, stock rises $1 up to 79. Good thing. SEP 80s also drop in price. So we had, in 24 hours happen what oftentimes would take, longer than that, but stock up $1 and implied's down. So certainly for the person who put on that covered call, buying the stock, selling the call, big time overnight winner here, at least on paper. And if you had the other side of that position where you were short the stock and long the call, you clearly weren't too happy with implieds getting crushed like that. So let's get on to using implied. After all, I think that's the key here. As we know, stock vol, that's behind us. Implied is all about, what the market expects going forward. So volatility measures are expressed in standard deviations. I don't like to get too much into the math with everybody, and we start talking standard deviations, and maybe your eyes start to roll just like a lot of people's eyes roll when we start talking about the Greeks. But these don't have to be complicated topics. So let's just kind of stick with an example here in terms of standard deviation. We'll have an example where we got a 30% standard deviation from the mean price on an annualized basis. So that means that for about 68% of the time, this particular stock should trade within one standard deviation. That's really how the math works. And we can look a little bit more at standard deviation. XYZ, $80. It's trading, as I said, at an annualized 30% implied vol. That one standard deviation of 30% implied represents numerically, again, we've got the stock at 80, multiply that by the 30% implied, that gives you $24. So you can see you've got a real wide range on an annualized basis. We're talking annualized now. Over the course of a year, if that $80 stock is trading at a 30% implied, we can expect 68% of the time that stock to be trading in a range between 56 and 104. That's 80 minus the $24 and 80 plus the 24. That gives us that range. But again, that's over the course of a full year. So the rest of the math, when we talk standard deviations, one standard deviation will represent 68% of the time, 2% will represent 95% of the time, and 3% almost 100 at 99% of the time. But you can see how those price ranges do continue to increase as we go out to 2 and 3 standard deviations. And this is where, if you are, somewhat inclined towards the math, you can back into the standard deviations to help you define, some strike prices that maybe you want to, employ different option strategies. And the way we can do different calculations, you take basically the annualized volatility and calculate the standard deviation amounts less than a year. So you take the implied over the square root of the period of time times the stock price. And I'm not going to go any further with the math, but this is kind of how it looks. If we were to do it on a one-day basis, and so why do we care about one day? Well, think about it, having a sense, and again, it depends how close you are to the market. One day is for, an investor who is watching that market awful close, making an awful lot of trades. So maybe there's a happy medium where, you do it on a monthly basis. To give you a narrower range than we got when we annualized. We had with an $80 stock, a range of 56 to 104, those strikes aren't worth a whole heck of a lot unless you got an extraordinary, you're talking about 30% implied. So it's not like you're going to be able to sell any credit spreads out on those wings for any real kind of return. But that's why, looking into calculating on a, less than annualized basis may allow you to, garner some insights into the strike prices that you want to employ different positions. So on a one-day basis, basically you take the 30% divided by the 200 square root of the number of trading days, which is 252, times the $80. That gets us basically, when we do the computation, a $1.52 range. So to the downside, we're talking 78.48. To the upside, we're 81.52, 68% of the time. And again, a day is probably too narrow for most of us, but the idea is to allow you to think a little bit, maybe in terms of this implied volatility, on the underlying, and where the expected stock movements may take that underlying to, and at what point and what option strategy do you then wish to employ at those particular levels. So being aware of implied levels, we've referred to that, a little bit. Just have an idea, just like your underlying, whether they're, to the high side or the low side. And, here's another example. The blue line is the historic volatility. The green lines are the implied. And, just have a sense, if I'm doing a covered call, or the implied's on the low side or the high side, it may not matter. You may just want to sell that call in that underlying, no matter what the premium. I personally like to have a sense for whether that premium, is historically at a low, average, or high level. But, that gets back to each investor does things their own way. Investing in implieds, as I mentioned earlier, we've got three different strikes here, and as you move from either in or at the money to out of the money, implied volatilities do go down. That's because of the natural market skew in the option space. Also, depending on what month you're in, implied volatilities can be dramatically different. And again, from a common sense point of view, earnings months, especially for those companies who really tend to surprise with earnings announcements, those premiums will typically be far greater than surrounding months. Let's talk a couple option strategies in terms of what's good and what's bad as it relates to implied volatility. So we started our discussion by talking about, option premiums. We've got intrinsic, if the option has any in the money value, and then time value. Well, at expiration, clearly, the option only has value if it is in the money, whether it's a call or a put. So time value at expiration is out the window. And these different movements in implied, the expansion and contraction in the time premium, depending on your position, whether it's risk managed or, unlimited risk, depending on what you've got on, those changes in implied may force you to cover early, take a loss, if you're on the plus side, maybe, scale out profits as premiums continue to go up. But again, that gets back to the individual investor. Long positions, of course, take advantage of higher implied, short position, or uncovered. They're going to make money when implieds go down, but they also have an awful lot of risk. So let's talk about a couple specifics. Long straddles and strangles. Let's go back to XYZ and say it's trading at $50. The straddle is going to be long the call, long the put. And if we're talking a strangle and the stock's $50, we're talking out of the money call. So let's say a 55 call and an out of the money put. So if the stock's 50, we'll say a 45 put. So they're equidistant. So long straddles, long strangles, again, common sense that we're long two options. Implieds go up, premiums go up in both the calls and the puts, in addition, to the value that they gain with the underlying moving. So, anything where we're long options, for the most part, almost always, net long option positions, unless they're so far out of the money, the implieds aren't impacting the premiums too much. But, the vast majority of the times, long option strategies are going to be big winners with implieds up. Another example would be a back spread. That term may be new to some of you, but what's important to know about the core concept of a back spread is that the strategy involves buying more options than options you sell. So let's go back to XYZ in our $50 stock. If we do a call back spread, we would be a seller of the, let's say the at the money, the 50 strike, and we're going to buy on a ratio the 55 strike. So, that ratio can be, 1 to 1.5, it could be 1 to 2, it could be 1 to, it can be any ratio you want. But the bottom line is you are net long options. So if we have that 55 back spread and the stock at expiration is 50, if we didn't pay anything in terms of the net, if we were able to do that trade for either even or a credit, because the out of the monies were so less expensive than the at the monies, if the stock went out at 50, we would take in that credit or only lose commissions if we did it for even. If we did it for a debit, because we bought so many options it cost us more money, then of course we'd lose the debit. The worst case scenario in a back spread is when that underlying goes to the long option strike. So if we had a back spread on where we're short the 50s and long the 55s, and the stock at expiration goes out at 55, those 50s are now going to be worth $5, where those 50s are worth, if the stock is at a 55, they're worth nothing. And then, the question is whether you have to exercise to offset, your negative or your negative delta hedge by being short the 50 calls. So that's the back spread. You need, before expiration, those premiums to expand, and or you need that stock to go flying through 55 so your net long options can kick in. So that's long straddles and strangles and back spreads on the long side. And the last bullet on the slide here says these strategies carry limited risk, and that is true. It may be not insignificant risk. You buy an at-the-money straddle in a fairly volatile stock, you may pay $5, $6, $7, $10, $15 for that at-the-money straddle. So that's a heck of a lot of money to potentially lose. But at least, what the maximum loss is. The other thing is, just because you pay, $5, $10, or $15 for the straddle doesn't mean, you hold it to expiration, and if the stock is at a 50, you watch it go to 0. That's the beauty of investing. Things change, you get in, you get out, and you move on. Strategies that want implied down. Well, again, from a common sense point of view, strategies, that typically would be net short options, or certainly strategies that are short vega. In our examples here, we're talking about short option strategies. So the short straddle, which we talked about, the short strangle, of course, we're net short options. So, if implieds come in, we're going to make money. If implieds come in, the time premium is going to collapse. And if our example is XYZ at 50 and the stock hangs out around 50, we're also going to have the benefit of that theta on top of the collapsing time premium because of the implieds coming in. So that can be a double-edged win, where the stock just hangs out at or in between your strikes and the implieds come in. Ratio spreads. Now, ratio spreads, whether they're calls or puts, and when I did the back spread, I did a call example. The ratio spreads are net short option positions. And so the last bullet is really important. These strategies carry unlimited or very substantial, in the case of ratio spreads with the puts, very substantial risk, as an underlying could potentially go to zero. To the upside, it goes to infinity, and that's why we say some of the risk to the upside is unlimited. But ratio spreads, on the flip side of the back spread, you're going to be maybe long the 50 call and then short the 55s. As an example, where you're going to be long one and short more than one of the 55s, maybe on a ratio, like I said, of 1.5 to 1, or some far more significant ratio than that. So before we wrap up and go to questions, why don't we go through one of my favorite slides here and just talk about, from a volatility standpoint. Long call, every long call has vega. So you've got unlimited profit potential to the upside, and you have some vega delta. Okay, that one slide that we showed early on, I think it was slide 16, talked about showed an implied vol of 27.27. So if we owned one call, we'd be long 27 vegas. If we owned 10, we'd be long 270. And if the implied vols go from 10 to 20, your time premium doubles. And that's why I think it's important for us to pay attention to vega. Short call is going to be a short vega position. Obviously just the opposite of the long call position. But notice, the long call, you can lose what you pay. Your profit potential to the upside is theoretically unlimited. Your short call, you can only make the premium that you sell the option for, but you have a theoretical unlimited loss. Long put, long option, long vega. Short put is going to be obviously a short vega position. We talked about the long straddle and the short straddle. We also mentioned the long strangle and short strangle. Notice the difference. You've got that horizontal line that covers the difference between the strikes in the strangle position, because you're talking an out-of-the-money call and an out-of-the-money put, versus you can see that 1 point with the straddle, because both the call and the put are at the same strike. That's why when you do the strangle and you're talking the out of the monies, the strangle is less expensive from a price standpoint than the at the money options that you put on with the straddle. But then your break even points are wider as well. But long straddle and strangle, obviously long volatility. Short straddle and strangle, short volatility. Long call spread. Okay. We're talking about a long vertical call spread, long one call, short another. Typically, you're going to be long an in the money or an at the money, and short maybe an out of the money. So you're going to be slightly long vega, but that's really more of a delta position than it is a vega position. Long put spread, same thing. You're going to be long an at the money or in the money put versus an out of the money. So it'll be, net long a little bit of vega, but more importantly, it's the delta in that position. Short the put spread is, going to be just the opposite in terms of its delta. It's going to be a long delta spread, and it'll be short a little bit of vega. But when you're talking vertical spreads, again, the risk is more on the delta side than it is on the volatility side, because after all, you've bought one option, sold another, same month, different strikes. So both of them have vegas, and they offset one another to a point. Ratio call spread, we talked about the ratio, whether it's a call or put spread, net short options. So depending on the level of the underlying stock, and it does depend where the stock is, your vega will change. So depending on what level the stock is, you may be you could potentially even be long vega with those ratio call and put spreads. But again, it gets back to the level of the underlying. Vol spreads are, net long option spreads are going to be long vol. And then the collar is going to be, a collar, for those of you who don't know, is long the underlying, short and out of the money call, and long and out of the money put. Tends to be close to vega neutral. So, Nick, I think, I guess a couple more slides just to wrap it up, and then we'll go to Q&A. And most of this really I've talked about. So as Nick said, we always have our presentations up within an hour or two if you want to go back and review some things. But a lot of what we talked about in terms of just be familiar with the underlyings and their implied levels, and then, have a sense for you're going to buy at the low or, maybe buy at the high because you want to get in, but just have a sense for the levels. Know the impact of implied vols as the underlying moves, and you can see how implieds move. Again, going to the website, under tools and resources, that position simulator. Just put in, a call, put in a straddle, a strangle, and watch how that vega position moves. The further out you go in time, and I haven't said this yet, and this is actually important, options have more vega as you go out in time. So here we are about, coming up to April expiration. You look at your April options, you look at your July options, you look at next December options, in your favorite underlying, and see how the vega changes over time. That's where the risk is, in the options as you go out in time. It's the vega, not the theta, the further out you go. So that's something, you can look on your platforms or at optionseducation.org on the option chains and look at some of those different vega levels. Optionseducation.org, I mentioned a few times. I don't know if Nick mentioned, but we've got our wonderful option pros at the 888 Options Investor Services Desk for you every day. We've got our mobile app and the YouTube channel. And Nick, I think time for some questions, buddy.
Absolutely, Joe. And before we get to them, we've had a number of questions, and I know you mentioned it as well, that I want to remind our listeners that today's session is archived and will be accessible in a few hours this evening using the same link you used to join us today if you want to review anything that Joe has discussed. Additionally, all of our webinars are available on the OIC YouTube channel, so you can review a number of option strategies and concepts at your own pace. And as Joe just mentioned, if you do have further questions about the concepts we discussed today or any of the tools on the OIC website, you can always call our investor services team at 1-888-OPTIONS during normal business hours. They're always ready to help answer questions about option strategies or positions. And Joe, our first question, let's go all the way back to one of those opening slides, and I think you called it your favorite slide. Was there a specific reason for that jump in options volume back in 2011 and the subsequent decrease in the volume and since?
Yes, as a matter of fact, and thanks for the question. The trend has been up, as we know, but in 2011, in actually August of 2011, that's the month that the U.S. lost its AAA credit rating. And so in that month, we did over 500 million contracts. I think the 4 busiest days in the history of the option business took place in that month. To give you a perspective, from 1973 all the way up to the year 2000, the industry never, over the course of a year, in any one of those years, traded 500 million contracts. We traded over 500, I think it was about 550 that month alone, August of 2011. And because of that, we got the spike up to 4.6 billion contracts that year. Another thing I'd like to point out, without that spike, we'd probably just be step staring up slightly each year, and that's in the face, with the exception of maybe the last 4 to 6 months, of a relatively low volatility environment. So, stock volumes have decreased, and fortunately, option volumes have continued to grow, and I think, by and large, because a lot of investors got beat up in 08, 09. We're looking for other choices. Options, they're dynamite financial tools if you learn about them. There's a lot of misinformation out there, Nick, that, options are so risky, I'm staying away. They can be risky, but, with some education and then practical application, they're great tools for both risk management and income generation.
Absolutely, Joe. And we got a number of questions toward the end because you started mentioning Vega, one of our Greeks, pretty frequently. So a 2-part question. One, can you go into a little bit more detail on what Vega is? And then the second part, how can you check if your option position is long or short Vega?
Okay. Vega is is basically a nickname for implied volatility. Okay, so it is that component in the option price that speaks to the expected amount of movement in the underlying going forward, and it's a huge factor when it comes to the pricing models. And if you get into your platform, and as I mentioned as we're kind of wrapping up, go out in time and you'll see how the Vega will increase as you go out in time. Lower price stocks are going to have less Vega than the higher price stocks and indexes. So the higher the price, the bigger the Vega components. The lower the price, the smaller, but consistently as you go out in time, the Vega number will grow. And in terms of how do you figure out whether you're long or short Vega, well, you can do it a couple different ways. You plug it, you got your position on your platform, you just net out your option positions against the Vega that your platform gives you. But be careful that and this, we'll get off tangent a little bit here, Nick, but all the platforms have theoretical prices. If the theoretical price, and I'm not saying live and die by theoretical prices at all, but the theoretical prices are the basis for the different factors that go into the pricing. And so if your theoretical value, let's just say the theoretical value is $5 on your particular option that you're looking at, but the market is $5.25 bid, offered at $5.30. That means something's wrong in the pricing model, and chances are it's the implied volatility. The implied volatility should be higher. And so that's just something to be a little bit aware of for those of you who are new to the space. I may be losing you here a little bit, but just double check the theoretical value with the bid-offer spread in the market for your options, and if they're in sync, then the implied Vega number on your model is going to be in the ballpark. And then, if you're long 10 options versus short 10 options, just go to those particular options, find the Vega for each option, net it out. That'll be your Vega position. Better yet, you can go to our website at optionseducation.org, go to the pricing simulator. If you don't have a position, but you want to see if, long a straddle, long a strangle, what's my net Vega going to be? Plug in that position and it will give you your net Vega. So there are a couple different ways to approach it.
Joe, if the implieds go up, do both call and put prices also go up?
I'm glad that person, whoever there was, asked the question because I did mention it earlier, but yes. And it's an important distinction that I was trying to make between historic versus implied. Historic, as we said, is that movement in the underlying in the past. Implied's the market's expected movement going forward. If the premiums go up because of put-call parity, the relationship between the underlying, the put, and the call can't go up. The premium call can't go up without the put premium going up by a corresponding amount. That's how the game works. So yes, if implieds go up, call premiums and put premiums. That's the premium portion. It's not to say that the value is going up by the same amount. If the stock takes off, clearly the delta in the call is going to increase, so the calls are going to increase in value based on the value of the underlying. But the premium component, if the calls add 20 cents in premium, the puts will add close to 20 cents in premium because of the expansion of implieds.
Joe, how does implied volatility impact gamma?
Two different animals, Nick, two different animals. And that's why I didn't get into it in any great depth tonight, but I did mention that, you can actually be short volatility without being net short options. And so, gamma is, like I said, it's a different animal because gamma is the measure of how much the delta changes with the move in the underlying, and vega is just the expected amount of movement. So we're talking two different animals, but let's run through an example. If we're short, let's go XYZ, and let's say we've got an April and a September position. We're long April. XYZ is $50. We're long the April 50 straddle, and we're short the September 50 straddle. So we're going to be long gamma for sure because we're long those calls and puts in April front month. The closer you are to expiration, the greater the gamma. The further you out in time, your gamma tends to decrease. And your vega would be, because we're short September. Those September options are going to have far greater vega than the April options. So it's essentially short a time spread, short a double time spread when you're short the call and the put. Long front month gamma, short backdated vega. Two different animals, Nick.
Thanks for the clarification on that, Joe. And we're a little bit over our time, but we have time for one last question. And this investor wanted to know, can volatility positions be hedged?
What do you think?
I think the answer, Joe,
Nick?
is it depends.
It's close. They certainly can. I mean, when we talk, this is a webinar on volatility, clearly. But when we talk about hedging, lots of the Greeks can be hedged. In terms of hedging volatility, absolutely, no question about it. You go to your pricing models. There are so many different ways. I mean, I can't get into all the different ways, but it's really no different from a delta hedge. You take one option, you hedge it against another. Maybe you have a little long delta, a little short delta, depending on what strikes. But definitely, vegas can be hedged. The thing, much like hedging the other Greeks, you always need to be mindful of the risk and how you're hedging. Did you have to sell more options, in this other strike and month to hedge that other volatility risk. That may be the case. So you may have hedged your volatility, but then you may have created a bigger problem with an upside or downside move in the underlying because now you're net short options. So maybe, Nick, that can be a webinar also for another day, hedging the Greeks.
I think that's a great idea, Joe. Do you have any closing comments for our listeners today?
No, I just wish everybody a happy April Fool's Day tomorrow.
Ladies and gentlemen, thank you so much for your time this afternoon. And while we weren't able to get to all of your questions, we had a high volume of them today. We do have our investor services desk ready to help at 888-OPTIONS, available during most business hours to answer your questions. Feel free to reach out to them. And again, today's session will be archived and accessible in a few hours with the same link you used to join us today. Additionally, our webinars are available on the OIC YouTube channel, so review the option strategies at your own pace. And of course, make sure to check out optionseducation.org in the upcoming weeks for our 2015 sessions that are going to be coming up. Our next one will be on April 21st, where we'll be discussing butterflies and condors, two popular option strategies with defined risk. Thank you again for attending, and we hope to see you again next time.